We need to dive deeper into the psychology of the bank and the hidden insurance trap that most people ignore until it's too late. This adds layers of tension and high-value advice to the storyline. Imagine a couple standing in the kitchen of their dream home, staring at a letter that feels like a ticking time bomb. A few years ago, they signed their mortgage papers with total confidence, locking in a rate that made homeownership feel like a breeze. They planned for the future, but they didn't plan for the mortgage cliff. As the market shifts and interest rates climb, that manageable monthly payment is about to transform into a massive financial weight. This isn't just a minor adjustment, it's a total budget overhaul. The shock hits hardest when you realize the bank isn't necessarily on your side. When that renewal letter arrives in the mail, it often contains a suggested rate that assumes you are too busy, too tired, or too intimidated to shop around. They are counting on your inertia. But the math is cold. On a $400,000 balance, moving from a 2% rate to a 6% rate isn't just a 4% increase. It's a massive surge in the interest-to-principal ratio. In the early years of your new term, almost every dollar you pay will go toward interest, barely touching the actual debt. Then comes the hidden predator, the insurance trap. Many homeowners forget that their mortgage payment often includes an escrow account for property taxes and home insurance. Because repair costs and climate risks have driven insurance premiums up by double digits, your bank may realize your escrow account has a shortfall. This means even if you negotiate a decent interest rate, your monthly payment could still spike just to cover the insurance gap. You aren't just fighting the market, you're fighting inflation in every corner of your home's overhead. To survive the shock, you need to look at 3 specific lifelines. First, consider an amortization reset. If you've been paying your mortgage for years, you've built up time equity. By stretching your remaining balance back out to a longer term, you can lower the immediate monthly pressure. It means paying more over the long haul, but it keeps your family in the home today. Think of it as a survival gear shift for a steep hill. Second, don't wait for the renewal deadline to act. The most successful homeowners use a blend and extend strategy. By talking to your lender months in advance, you can merge your current low rate with today's market rate. This creates a smoother, hybrid rate that starts early, preventing that violent overnight jump in expenses that shatters most household budgets. It's about taking control of the timeline rather than letting the calendar dictate your stress levels. Finally, remember that your home is more than just a shelter. It's an equity shield. If your property value has grown since you bought it, you have a secret weapon. You can use a strategic refinance to consolidate high-interest debts, like 22% interest credit cards or 12% car loans, into your 6% mortgage. Even though your new mortgage rate is higher than your old one, your weighted average cost of debt drops significantly. By rolling everything into one payment, your total monthly outgoings can actually fall, giving you a clear path through the storm. The story doesn't have to end with a for sale sign. It ends with a strategy. The key is to stop being a passive passenger in your financial life and start shopping for your next term at least 4 months before the clock runs out. In the battle of you versus the bank, the person with the most information and the most time always wins.
If you like this content, go ahead and subscribe. And please, like and share this video.